Hi everyone, welcome. We're just going to wait a few more minutes for people to log on. You can see the eyeballs ticking up slowly.
Nice. I think there's a few people joining us tonight on their date night, which is wonderful. We've got these three lovely faces to join
Midweek
in.
date nights, right? Midweek takeaway date night, I think, clearly in this environment.
Yes.
I know. It's very impressive.
It might be like a my food bag, make it from home date night.
Yeah.
Love it.
Definitely if you're in Auckland.
Yes, yeah.
The one thing I'm looking forward to is not cooking for a change.
Yeah.
Definitely.
Do say hi if you're logging in. Obviously looking forward to seeing all the chats and questions as we go. I've been warned that this is a very rapid fire. We're covering a lot of topics tonight. A lot of questions. Great.
Get ready.
Yes.
It's going to be so good. Cool. Well, I think we should kick off. Welcome everyone to our personal finance webinar, where we will be covering off and answering all of your money and investing questions. A little bit of context. I am Christine. I'm part of the Kernel marketing team, and tonight we are chatting to Dean, Kernel's founder and CEO, and Kat, Kernel's head of marketing and customer strategy. So it is going to be, as Dean said, a bit of a quick fire session. We have a lot of ground to cover. It's all going to be good stuff. So we've got broad topics, investing in property, debt, the work. So don't worry, we'll get to it all. Little bit of housekeeping before we dive in. The session will be from 7 to 7:45. We might run slightly over, but we'll aim to hit that 7:45 mark. If we answer anything too briefly, feel free to pop extra questions in the comments, or if it's kernel related or quite broad, feel free to get in touch with us directly outside of the webinar. And then lastly, we just want to clarify that this is not personalized financial advice. It is general investment information only. So if we do touch on anything directly related to the Kernel funds, please do check out our product disclosure statement on the Kernel website. So let's jump in. First up, we have, I am new to investing. Where do I start? So who wants to take that? I'll fire that one to Kat.
Okay. Great question. I think there's probably a couple of things that we would always suggest you consider before you start investing to make sure that you have, I guess, your basic money and financial house in order. So these would be things like considering that you have, no consumer or personal debt, things like credit cards, afterpay, car loans, making sure that they are repaid in full first. Then the next thing would be having an emergency fund. So, whilst we don't like to think about emergencies, unfortunately, they do happen. They're a fact of life, and having a rainy day fund is really important. Then once you've gotten those two kind of key pieces, it's really about understanding your budget and your surplus cash flow, or what kind of available money you have to invest. And then once you've ticked that box, the world's kind of your oyster. And I guess this is where people get quite stuck because it can be quite overwhelming. So Dean, do you want to give us your kind of tips on, I guess, how would we best narrow down that very large world of opportunity?
I would say, first of all, I am breaking up my midweek with a cold drink, so do excuse me if I have anything as we go. And I'm going to completely sidetrack our whole thing already and say we've had a big discussion about consumer debt recently in the office with Afterpay announcing that you can now go to the pub and actually put it on Afterpay and rack that debt up for later days. So I think there are a lot of fascinating things happening in the world of fintech that, like I say, really need to make sure that you've paid off all of that debt and clear those things first before you get started. Opportunities. I guess the main thing that we're seeing, obviously, with fintech is that investing and growing your wealth is now incredibly accessible. Anything is kind of on the cards for you. But the main thing that Kat has mentioned is that you need to make sure that this is the right time for you. While things are now accessible and you can kind of get into anything from cryptocurrencies, investing, index funds with as little as $1, it doesn't actually mean that should be the first port of call. Go and deal with these other issues and then go from there.
Yep.
Nice.
Awesome.
Cool. Love it. And so next question, is it better to buy shares with one lump sum or small regular top-ups, and why?
Great question.
Really personal. Again, really personal. So a lot of science, a lot of stats will say that the lump sum is actually better. While, hey, even at all-time highs, a lot of the stats will show that actually the majority of the days after that, things will continue to rise over the long term. So time in the market is better than time in the market. These are things that you'll hear repeated all over the place. Personal element, though, is if this is a meaningful amount to you, no matter the size of the lump sum, if it's something that's meaningful to you, you may want to break it up just to smooth out and give yourself some personal comfort so you don't have buyer's remorse that if the next day it drops 2%, that all of a sudden you're like, what have I done? So splitting it out gives you some comfort that you're not so sensitive to what happens on those short-term days, and you can keep your mind focused on the long-term opportunity.
Yeah. I'd maybe just add to that as well. Like, it depends a little bit in terms of making investing really applicable and easy for you to do. So if you're investing out of your surplus cash flow, investing small regular amounts frequently can be a really good like money habit and investing habit to develop, as opposed to potentially having the really great intention to save that money up for a lump sum and then invest it, when of course, you know, lots of things could happen before that money gets invested that might kind of throw you off track there. So it also, you need to think about, I guess, what is a good money behavior and practice that would really help you get into investing and sticking with it.
Yeah, definitely. Do you have any examples of those? I think this is another question that we had later, is great investing habits or tips.
Yeah, so I mean, if you're new to investing and, you know, reasonably and understandably, it can be very overwhelming and somewhat of a daunting task. I think it's worthwhile thinking about what part of your personality is going to make you a successful investor. So thinking about the things, you know, am I the type of person that has had really good savings habits consistently and I don't touch my savings? I'm very disciplined and therefore I'd be able to transition that habit into an amazing investment habit. Or am I perhaps, like many people, you know, have really good intentions, but then potentially, like I do, spend too much of their fun money well before, you know, their next pay cycle comes around and can sometimes be tempted to dip into, you know, savings. If you err on that side, potentially you do want to have investment options that are quite separate from, you know, your day-to-day transaction accounts, making sure that it's not something you can easily sell out of at a moment's notice to then use the money for short-term expenses. So being aware of, you know, setting yourself up for success from the very beginning, because often with investing, we're our own worst enemy, whether we want to admit it or not.
Yeah, definitely. And so speak of setting ourselves up for success, emergency funds, we've got a few questions around that. Firstly, should I build up an emergency fund or invest or concentrate on the emergency fund first? So how, Kat, I'll throw that one to you.
Great question. There's lots of different options when it comes to emergency funds in terms of how much you should have. There's no real right or wrong amount. It is very relative to your personal situation. So some general rules of thumb that can give people guidance are, if you're an individual, $5,000 is a nice starting point, or if you're a couple, potentially $10,000. Then other people might also look to consider things like saving a certain amount of their pay. So say between, you know, 1 and 3 months of your paycheck, so that if you were to have some time off work unexpectedly, for example, you knew you had essentially the same amount of income covered for a certain period of time. So it's really, you know, it needs, I guess, to be relevant to your situation, because let's say for those that perhaps have dependents, are a bit older, potentially have a mortgage, saving a nominal amount like $10,000 may not be applicable for them. It may not be enough given the scope of kind of, you know, their month-to-month expenses or income. So I know for me at the moment, we have roughly 3 months worth of living expenses covered. Previously, I was in a place where I felt really comfortable just having 1 month. And then I think COVID's probably made me a little bit more conservative. So yeah, we boosted that up to 3 months.
Nice. And Dean, changing tack a little bit, do you have any tips for anyone investing on a low income or how they could approach that?
Yeah, again, I think it comes back to the accessibility thing has really changed, right? So again, is investing the right thing for you to do right now? Or are there other things that you could be prioritizing, like building up your emergency fund? Making sure that you've got those good foundations in place, because while investing may be really tempting and easy to do today, maybe there are other things that you need to tackle first, like paying down that debt. So we've got to come back to that. And then I guess it's the habits thing, starting small. If it is a low income, don't feel pressured. Like you'll see a lot of people talk about you need to put away 20 or 30% of your salary. Clearly, that may not be the case. Set yourself a realistic target that you can start with today and then build on that going forward. Just starting small and adding to it over time as you adjust is the key, because the reality is, for hopefully most of us, over time, our salaries will increase. And that's when you start to have things like lifestyle creep and you'll spend more of it. But as you go through that journey, as your salaries increase and as you have more capacity to invest and save, then you can start to increase the proportion that you're actually putting towards those things. So do just start small, address any other issues that you need to first, and then set realistic goals. I always come back to the gym analogy. Don't go hard and fast. Like, you're not going to go out there and realistically stick with a gym plan that's 6 days a week and keep that up for the next 10 years. Start with a couple of days, build yourself into it, and then you'll be able to adjust over time.
Yeah. I would add to that, like, there's a lot of research in New Zealand that shows that one of the most significant contributing factors to your overall sense of well-being is having a really good savings habit. And, for anyone that potentially feels like investing is not currently in their immediate short-term horizon because they need to tackle those basics, you can actually get a very large sense of, improvement and overall well-being by setting up those simple, habits and behaviors that Dean talks about. So as basic as it sounds, don't overlook them.
And we'll continue, but as small as these things sound as well, like, you may feel this is really small and not going anywhere. The earlier you start this, and I know we'll touch on this tonight, but the earlier you start this, as small as it is, if you've got a lot of time on your side, that will actually become really meaningful to your future. Mm-hmm. So don't feel disheartened with the size of it, because it will fundamentally change your life if you start with these behaviors and start small and start earlier.
And I guess also the same theory applies for investing with kids, right? I think, in that stage of life, often there's a lot of expenses and things like that. It's prioritizing even just a small amount, contributing that to the child's future can make a difference over time, which I know that we'll touch on later.
Yeah,
cool. And so for someone who is ready to invest, regardless of their income or where they're at, what and how should they go about researching what to invest in? That's a big question, but Dean, do you want to tackle that one?
Yeah, you may remember off the top of your head the stat from the FMA survey on the percentage of people that actually don't do research before making investments. It was nearly 50% or something, wasn't it?
I was going to say, I think it's just over 50% of Kiwis choose a financial product without doing any research into it whatsoever, which is quite terrifying. But I guess the positive message from that is there's only a small amount of research that you really need to do to make a slightly more informed decision.
Yeah, and exactly. So go out and take some time before you start to commit to anything. We put a lot of effort into the blogs and content we put out there to really help people from all spectrums get started or learn more or dive deep into topics. So there are a lot of great resources, blogs, contents out there that you can start digesting. As I said, it's surprising the percentage of people that don't do any form of research. So word of mouth and a friend and a hot tip is not the place to start. Get those core foundation things. And I think Kat's touched on it before as well, where it's about coming up with a plan. Like, what are you trying to achieve? And start at that point and then work back, because then you know a bit more about what you should be looking at, because the universe is very large. There's a very wide range of investments and savings and all sorts of options out there that you could be looking at, and you'll spend hours researching things. But if you don't have that plan, if you don't think about what you're trying to achieve, then it's very hard to get started. Then the fundamental tips come in, right? Which is get good diversification, keep fees low. That is where things like index funds are such an important tool, because it means that from the very first dollar, you're setting yourself up for stuff that's really well designed to help you get towards those long-term objectives.
Nice. Anything to add, Kat?
I think I would probably just reiterate that, in the sense that often you'll hear conversations in investment circles about starting by, say, investing in a company that you know, and that can be helpful in giving you confidence. But the challenge with that inherently is it also has a relatively high degree of risk because you're putting all of your investments into that one basket. And therefore, I guess, depending on what happens with the markets and that company in general, you can have quite a polarizing outcome because some of you will do really well, but others, and unfortunately the vast majority, will not do so well. So we would always say to people, if your starting point for investing for the first time, go and pick something like an index fund or an ETF or a managed fund that will instantly provide you great diversification because you're maximizing your chances of success, which is really important when we do something for the first time. No one likes to start something and then fail a couple of weeks later or feel quite stressed about the decision that they've made. So I think, it's often a great point to start with, say, an index fund. And then as you build your confidence, you can expand your investment universe that way. And therefore, you're hopefully more likely to maximize your chance of success.
I will add a little pitch in though for index funds. Index funds are actually suitable for everybody on every degree of the spectrum. We've got people with significant amount of wealth who use index funds for the vast majority of their investments because they themselves understand the value of good diversification and low fees. So as boring as they may sound, as much as we play it up as a starting point, they're actually the vast majority of where people are shifting their wealth to globally, and people are realizing the benefit of how they fit within the portfolio.
Yeah, nice. And so, Kat, as an ex-advisor, this one's for you. How much money do I need to start with if I want to use an advisor?
That's a great question. So the first thing I guess I would just say is if you're looking at getting financial advice for investments, you need to make sure that you're finding the right type of advisor because there's lots of different types of advisors in New Zealand that specialize in different areas. So making sure that you found someone that's fit for purpose with the knowledge and skill set that you need. Traditionally, one of the challenges with the financial services in general is that it has been tailored to those at the upper end. So there are a vast majority of advisors in New Zealand will only work with clients that have more than $500,000 to invest, which is a very big threshold. Now, as someone that used to be a young advisor, I am very pleased to say that there are having more and more younger advisors that are working with kind of people that we would call accumulators. So, those that don't have $500,000 but would like to maybe get there in the future, because I guess, how are you ever going to become that person if you don't have the foundations and the assistance from day dot? So there are a number of advisors out there that really help accumulators. And most of them, to be honest, will have a chat with you about strategy, goal setting, planning, even if you have $0 to invest, even if you're thinking about investing. So it's less about how much money you have to potentially invest and more around how they can help you set a plan so that you can grow that wealth. And then, if it comes a time where you need a bit more kind of hands-on guidance from an investment advisor, you could get that in the future.
I guess adding to that, just trying to distinguish on those two different types of advisors, right? There are a range. And so obviously we're big advocates for independent advisors that aren't tied to a specific product or anything like that. And you tend to have that more one camp, which is very much focused purely on the investment piece. So you'll go to them with your $500,000 and they will put together a portfolio for you. And that's kind of what they look at. Then there are a growing number of advisors who are a bit more, I would say, holistic, but taking the bigger picture, and it's helping with the planning part of it. And that's where a lot of people really get a value from. It's should we be paying down our mortgage? Should we be maximizing what we put in investments? What do we do for our kids? Like a lot of the questions we're talking today, that can really answer your specific personal questions. And you don't need a certain investment balance to go and see those types of advisors. They will help you with that bigger picture planning. And the investment part is, can be solved really easily with some index funds or other things. It's about the big plan and are you on track to what you want to achieve with your life? So definitely have a look out to those different types, financial planning as well as sort of financial advice.
Nice, perfect. Yeah. And so moving on to this great debate between property versus managed fund versus direct shares. Kat, which one is better to invest in?
It's like $1 million question, Christine.
I know.
Look, neither are better or worse than any of the others. I think this is probably the most important underlying message is we are very firm believers of there are all types of investments that can fit inside your overall wealth picture or your plan. They each can play a various different role. But the most important thing here is that you're pairing an investment that is applicable and relevant to a goal that you're trying to achieve. Now, there are a number of different goals that perhaps, our parents in the past solved through the likes of property that are now presenting quite a number of challenges for younger individuals. And also, previously there were times where it was a lot harder to access the share markets and people felt like they couldn't invest in, low cost index funds easily. If you look at it from a numbers point of view, historically, shares actually outperform both across New Zealand and Australia, and we do see this globally, the property market when you're looking at, longer term periods, so a period of 10 plus years. And it is worthwhile remembering that there are very different considerations with them in the sense that you can go and invest from $100, but you obviously can't access property from $100. You also have considerations like ongoing costs and liquidity and accessibility and the ability to use those assets for various goals. So I would say that one thing we often say in the office is that investing is not a religion. You can have a bit of everything. You don't need to pick one thing and stick with it. You can mix things together to make sure that they suit what you're trying to achieve. Obviously, we are big advocates for shares because we are 100% biased, but that's not to say that we don't appreciate property either.
And to your point, there's been a fundamental shift in the last few years, right? Where everybody used to be going into property, but now property is very inaccessible. If you wanted to buy an investment property, 40%, and with some banks now that's also restricted to debt to income ratios coming in, it's really hard. And it's a lot of capital up front. So the flip side being is that investing in equities in the capital markets has become really accessible.
Yeah. And I guess maybe something to add is, there is obviously a fundamental difference in the way that you see valuations and information of those two types of assets performing, which can often skew people away from shares because property, you don't have a valuer coming around to your house or your investment property every day to tell you the fluctuating value of what your house is worth. But we guarantee you it will be changing in value every single day. And it's exactly the same as, shares or investment funds. The challenge is that you can get that real-time feedback to see, am I in a gain? Am I in a loss? What's happening today? And that can be quite stressful for people. Naturally, no one likes to see that all the time. So it's just making sure that I guess you're aware that whilst we can't see as readily available the variations in prices of, say, property, it's not to say that it's any less risky or more risky than shares.
Yeah.
Nice. And so I guess there was the question of what about the consideration of leverage that is associated with property. Do you have any thoughts on that, Dean?
Yeah, so that's been the major difference between property and shares. Over the long term, we know that shares have performed better than property. The difference is that we've been very comfortable going and leveraging at 10 to 1. My first property that I bought when I was in Wellington, 5% deposit. 5% deposit with 20, 30 grand, you could go and buy a house, and we're very comfortable taking that sort of leverage and risk, right? But we don't do that with shares. Yet, if we did the same leverage into shares over the long term, historically, that would have done a lot better. So I think what we're seeing now, though, is that ability to leverage on property is becoming harder. It's challenging, more restricted, which is a good thing, generally. This then leads into that question, though, of a bit about sometimes people going, well, should I pay off my mortgage or should I invest? And that's kind of a scenario there where it ties in, well, actually not prioritizing your mortgage and investing into shares is kind of taking leverage to go and get into the share market and go and invest into equities rather than leveraging just to be in property. But that has been the fundamental difference between property and shares, is the ability to leverage accessibly and cheaply.
Yeah, nice, cool. And so in your opinion, Dean, renting versus buying, which is the best, or is there, a good option for people or preferred?
I think there's a lot of stigma, like a lot of things with money, where people feel pressured to buy a house, or I should be at the stage where I already own my own home. You've got friends and others, and you're looking at it and going, why am I not in that situation? I think I was talking earlier actually about this, and how so much of our life and our relationship with money is shaped by our upbringing and our family. And we pick up on a lot of the ways of how our parents engaged with money, how they treated it, how they discussed it, or more likely actually didn't discuss it. And we're seeing people change that. I think people are going out there and wanting to change their relationship with money and how their kids treat money as well. I would say that in my friend group, increasingly we're seeing younger generations being more open about the conversation of money, not only with how much they earn, but how much debt they have, what they're doing with their money. The key here, and a bit like the property piece, is not to look at that as kind of a benchmark and comparison. Everybody has different comfort levels. I've got friends who are extremely conservative. They don't like shares. They don't like seeing things move up and down daily. So the same thing with property. Don't feel pressured because others are doing it. Don't feel like you need to get into that journey. Kat may know what the average age is actually for first-time buyers. I can't actually remember what it is, but
it's 36 in New Zealand, average age.
So, you'll hear stories, or you'll hear the odd case of people buying that property, and the media loves to pick up on the people that have bought 5 investment properties at 21 years old, right? But that's not the majority. That's not an expectation you need to put on yourself, and do what's right for you. Like, I will talk about my personal scenario. I've been renting for a number of years, and I moved from Auckland to Wellington before setting up Kernel. I was working with NZX and the Stock Exchange. When I moved to Auckland, I didn't know anything about Auckland. I didn't know where I wanted to live, what was important to me. All I knew was I wanted to be relatively central, and I'm enjoying and where I am at my moment. For me now, renting is ideal. It suits my lifestyle. I'm focused on other things. I don't want the maintenance and the burden that comes with owning a property. It's not all happy days and glory. There's actually a lot of work that goes into owning and maintaining a property. And so I'm opting to rent, and I'm happy to continue renting for a number of years, because at some point I'll be at a point where I then want to go on to the next stage. So it's very personal. It's about not feeling pressured into buying something for the sake of it, and figuring out what's important to you at your life stage, and then shaping where you live around that.
Cool. Anything to add on that, Kat?
Yeah, I guess just that, to also have the confidence that there's other ways that you can grow your wealth outside of property. So if you're feeling the pressure to get on the property ladder because you think that that's the only way you can improve your future, that's absolutely not true. There are many people, and you look to other parts of the world where long-term renting is 100% a thing, and people choose to invest in funds and equity markets instead. And that's absolutely a genuine way to also grow your wealth. So I think, if you are in the renting situation and you're putting your money to work in other places, you should take a lot of comfort in that, knowing that you are also moving towards, growing your future.
Nice.
It's pretty clear that if you're watching this webinar, you're probably being more proactive than 99% of others. So, take comfort from it as well, right?
Yeah, definitely. And so if someone was in the position that they did want to buy a house and they were saving for that short-term goal, let's say 1 to 3 years, what should they do with that money in the meantime, Kat?
Great question. I guess this can also fit into the overall, what should I invest in question. So you'll hear a lot of rhetoric around the fact that you should only be looking at growth assets like investing in shares or funds for longer term time periods. So we would never suggest to anyone for a period of 1 to 3 years where they knew that they needed the money that they were saving for a specific expense, whether that be a home deposit, a wedding, whatever it might be that you're working towards. If you know that you have that shorter time horizon on it, you unfortunately really only have the options of kind of cash accounts, savings, and term deposits. And yes, we know they have very low interest rates and they're not very exciting, and it feels like your money is probably going backwards. But the alternate is that if you do go and invest it, you're putting that money at risk, because one guarantee of investing in shares is that at some point in time, that money will decrease in value, because there will be ups and downs of the share markets. The thing with that is that you just need to have a long enough time period to ride out all of those ups and downs. And we would kind of say that, if your time period is 1 to 3 years, that's not guaranteed to be long enough to ride any fluctuations along the way. So the boring answer is savings and cash. And then I guess the only thing to maybe think about is really considering your time horizon. And you'll see this a lot if you read any of our blogs or kind of commentary, is we really encourage people to think about, do you have a very set time horizon? So let's say with the example of saving for a home deposit, do you 100% know that you're going to buy a house in 2 years' time? Or is that kind of your general goal, but potentially you might be kind of flexible on that? And maybe you're aiming for it to be 2 years, but it could actually be more like 5 years. And understanding how flexible your time horizon is can help with opening up some of your opportunities.
I think that's also, it's interesting because there's some dynamics within the property space as well that reinforce this. So obviously changes to the regulations around investment properties and deductible interest is a lot more focus. And a lot of first-time buyers are looking at new builds. So investors and a lot of first-time buyers are looking at new build properties and new developments, and they can actually get into those with pretty low upfront deposits. You're getting in there with the 5-10%, but you may then have 1 or 2 years before you actually have to settle on those properties. At which point you may need a greater deposit, and the bank valuation may change, and you need to top that up. So there are some people out there that we're seeing it's really easy to sign up to buy this property, and hey, it's a couple of years down the line. You do really need to make sure that money is available on the day, because you've signed the contract and you're going to need to deliver on it and make sure that you're ready for that in 1 to 2 years' time. So unfortunately, there's not many options. At least interest rates have started to rise. So maybe instead of getting, 0.25%, you're getting 0.5%. So things are improving.
It's looking up. Oh, I love it. And so we've kind of touched on this a little bit already, but should I pay off my mortgage or invest, Dean?
Yeah, touched on it already, and plenty of questions get there, I'm sure. So you can ultimately think about not paying off your mortgage in the sense of leveraging to invest in the shares, where you're just prioritizing where you put your money. Always talk to this one, though. It's a very personal decision. Some people have a real aversion to holding debt, and it creates a lot of discomfort. And you can't discount that emotional element that it comes to it, that how do you view debt? How do you feel around having debt, particularly of such a large magnitude as a mortgage? So you may want to go and pay that off. The math is simple. If you expect a return on investment is higher than the interest cost on the debt, prioritize investing. The risk and the caveat is that the return on the investment is not guaranteed where the debt is. And so that's where the risk comes in, and that's where the personal views on how comfortable are you with that come into play. But we are seeing an increasing number of people going, actually, made good progress on the mortgage. I'm not in a rush to pay it off. I actually want to build up some assets outside of the house, and I've got some disposable income. I'm just looking for a way that I can regularly kind of invest that and build up a couple of different options so that I'm a bit more diversified and balancing it out a bit.
Yeah. I would add to that to sometimes, I guess, challenge people's thinking on this, because I get quite bullish on the fact that, Kiwis have quite an intense fascination with being debt-free, which absolutely respect. But I guess for me personally, I actually feel quite a high sense of risk having so much of my wealth tied up in one asset, in one street, in one suburb in Auckland. And I had a lot more comfort prioritizing, once we could, investing over necessarily making additional repayments from our mortgage, because for us, I felt that that was a much stronger way to be well diversified and lessen our overall risk to one major asset class. So it's just, as Dean says, what's your comfort level and how you approach your overall wealth.
Yeah, cool. And so moving on to diversification, you touched on it a little bit. How many funds should one person invest in to be considered well diversified, Dean?
Yeah. Ultimately, you could do it with one, right? Buy a total world fund and you're done. It's this or a diversified fund. You can go out there. So and I think people think about this more along the lines of KiwiSaver. We've become quite accustomed to I pick one KiwiSaver, right? So you get your growth or your balance or your conservative. Ultimately, that's a fund. That's a single fund. And so you could do the same thing outside of KiwiSaver. Just go and find a growth or a diversified fund and invest, and it's done. That's great. It's easy to do, really set and forget. For those that are trying to make something that suits their own goals or interests, you may want to pick a few different funds, and that's because you're trying to invest in things that are relevant or meaningful to you. I think the key here is there's no set answer, there's no right number, but I would say that there probably is a wrong number, and 30, 40, 50 funds is a wrong number, because you're not doing anything to change the diversification, you're not changing your risk, you're just adding costs and complexity. And we have seen people like that. We have seen people who have used platforms where you've got an open universe, where you've got thousands of options to choose from, and they've come to us and gone, hey, I've got 34 ETFs. Am I diversified? No, you haven't done anything yet. Like 1 or 2 or 3 funds. The key with diversification is ensuring that you've got a mix of asset classes. So by that, we mean like if you're got a long horizon and you don't need your money for sort of 10 plus years, hey, that could be just growth assets. By that, we mean shares or equities. If you've got some more short-term needs or you're a bit more conservative, then you may want to mix into that some more income assets. So that's bonds and other assets. So that's the first fundamental split. And then the next diversification piece is, well, are you diversified across a range of countries, a range of sectors, and therefore a range of companies? So you don't actually need many funds to achieve that. 2 or 3 funds, and actually you can be split across a range of countries, a range of sectors, and a range of companies, and you're done. So keep it simple, keep it manageable. Like I say, there's no right answer, but there is a wrong answer.
Cool. Love it. And so, Kat, how do you decide to split your investments between property, shares, and cash, etc.?
Great question, Christine. I would say it starts with your goals. So as Dean just touched on right then, you have the option of looking at, say, growth assets or more defensive assets. And how you would choose between those as a starting point is A, knowing when you need the money for the particular thing that you're saving or investing for. If it's a shorter term time frame, so that 1 to 3 year period that we're talking about, you really limit yourself to the more conservative universe to make sure that that money is available when you need it. If, however, you're working towards a goal that has a much longer time frame, so 5, 10, 15 years, or an undefined time frame potentially, you open yourself up to growth assets like property, shares, funds. Then I guess deciding exactly which you want probably comes down to what's your starting point in terms of balance. Because, on the property piece that we talked about before, if you're wanting to get in with, say, $10,000 or $20,000 worth of savings, having an investment property or doing that through property is probably not an option for you. That's not to say that you can't invest in property, because you can actually get exposure to areas like commercial property through the likes of index funds or various listed companies. So, it's not like you're excluding that asset class entirely if you're not going down the path of buying a direct property. And then I think once you've kind of narrowed down your options that way. As Dean touched on, it's really just making sure that you're comfortable with enough country and sector exposures and thinking about, how much do I want to have invested in New Zealand equities or share markets and global share markets as a good starting point. I feel like property, though, it rules itself out for a lot of people, right? Depending on what your resource or your goal timeframe is.
Cool. Yes, I completely agree. And so, in the same kind of vein, we had a question come in from someone that's asked, we're in our late 30s and have 250K to invest. Mortgage is under control. What would you do with a sum like that? Kat, I'll throw that one to you.
Bring in the advice.
This person would be a prime candidate for going and chatting to a financial planner, and because I think the main thing that you need to do is really think about what your goals are, right? And start to dream a bit big, because you've obviously made some really good financial decisions in your life to get to that point in the first place. It's then about really understanding what you want the next 10 years or 15 years to look like, and helping get some guidance around how you can achieve that. So, I think when we were reflecting on some of these questions, a lot of people jump to almost wanting to know what the product or investment solution is before potentially really understanding what they're trying to solve. And I think this is a good one, right? Because I can completely appreciate that you would be quite stressed trying to think about what to do with such a large sum of money. And I guess, you can't really go wrong if you know what it is you want to achieve first, because that's going to start to point you in the right direction and narrow down your options.
And just on that, it's not a big cost. Like if you've got a small balance in the plan, like even if you don't have a large amount to invest, coming up with a plan and getting advice on a plan is actually a really useful investment in yourself as a couple, as a family, whatever it may be. So financial plans, for some context, you can get a lot of financial plans as a one-off process with an independent advisor who will sit down and work through all of those questions with you. And hey, ballpark that can range from $1,000 to $10,000. There's quite a spectrum in there, but we're talking a couple of $1,000s. And if you're someone particularly in this situation, right, where you've got a large amount of money, this is a pretty small fraction of that to go and just sit down and help work out the plan. And I guess one of those things, a lot of the role of financial advisors as well, is also what do each of you as a couple view your goals are, and how are you each comfortable with different types of investments? Because actually, one of the big roles that advisors will often say they play as the therapist is you often talk about to cats, like saying, like, you talk about the end thing of what are you going to invest in or something, but you're often not fully aware of the nuances of what each of you think about. I don't want to invest in property, but others maybe, I only want to invest in property. Let's leverage up and let's go hard, right? And so that role of that advisor can be really important with flushing out some of those questions between you as well, so you get that clarity.
For sure. Cool. We've just a little bit behind schedule, so we're going to quick fire them from here. So next question, what investments would you recommend when only 3 or 4 years away from retirement? Currently have most property, Kat?
Yeah. Okay. So obviously we can't make specific recommendations about individual investments, but I guess my starting point to this person or anyone in this stage of life would be, you don't need all of your retirement money the day after you retire. Thinking about our life expectancies and where we're at, if you retire at 65, the vast majority of us are going to live for another 20 years. So you actually still have quite a significant time horizon that you need that money and that capital to be invested in. And so often it is a relatively incorrect assumption that people assume that I retire and I become super conservative. So
that was easy to do, right? Like 10 years ago, 15 years ago, yeah, you could just go and put it in a term deposit and get 6-7% from term deposits. And yeah, you would be fine at retirement. Doesn't work today. And to Kat's point around it, about 25% of females, and I think it's just over 20% of males, will live into their 90s. So you could have 30 years in retirement to fund. It's not an immediate thing where you need all the capital and you're going to spend it over the next 5 to 10 years. You need to ensure that you don't run out of money. Is probably your biggest risk.
Definitely. Okay, cool. And so we had a couple of questions around investing for kids. So a lot of people have some savings that perhaps they have on behalf of their kids and are wanting to look to invest that. How should they go about investing that money? Dean?
I love kids because I think it's a great time to talk about tax, which is my personal favorite.
Like the unknown tax haven that you never knew about.
Yeah. Kids have different tax rates than most of us, so that's an opportunity there. Does also mean that you should think about your investment stuff, right? Because there are different investments. Like if you're looking at funds in New Zealand, all the listed funds, so ETFs, are actually taxed at a flat 28%, whereas an unlisted fund like Kernel is taxed at the investor's PIR, so it could be down at 10.5%. So that's quite a meaningful difference to consider if you're looking for investments for kids. Obviously, there are a range of other considerations like access and how you're going to manage it. But they are little nuances that could make a meaningful difference. Doesn't take away from actually the biggest difference is actually starting. So starting investing with kids, undoubtedly, fees tax kind of does become pretty small in the context of the fact that if you start early and start putting a couple $100 away for your kids at an early age, when it comes to 18 or 20, whatever that age is, they will have a fantastic head start on their future because you've taken some proactive action to put away pretty small amounts. And that comes back to actually the point that we were making about starting investing when you're on a low income, these may seem pretty small amounts, but putting away $100 here and there, 20 years later, that actually grows into quite a significant investment. And so just taking action and getting started, all the things we talked about today so far are relevant for the exact same thing for kids. But there are some added bonus benefits that you can go and look at, things like tax.
Cool. Love it. Anything to add, Kat?
No, that's good. I think tax is the big overlooked one.
Yeah.
So
Cool. Yep. Cool. A little bit of a random one. How do I know when to sell a fund that hasn't been performing well?
Love this question. I'm just going to handball this to Dean.
There are a couple of different things, right? If it was a company, a single company, right, it's very different to a fund, because a fund is diversified. I have no idea what fund you may be talking about, whether you've gone into some high-risk crypto fund or whether it's a well-diversified global fund, because there's a very broad spectrum there. I guess the key thing here, what we will broadly talk about with good investing, is that if you're setting yourself up for long-term investing and you've got that structure and you've got the plan in place, you shouldn't be making investment decisions because of short-term performance. The idea of selling or buying because of short-term noise is not where you should be starting from. It should be because your circumstances have changed, you've got closer to your horizon when you need that money. Those are the things that really should be triggering you to buy or sell. If this is a good, well-diversified fund that is made up of a range of companies or sectors or whatever it may be, and is part of a diversified portfolio, and you don't need the money 5 or 10 years, I'd question, why are you trying to sell it? Is because you feel like you're reacting to the short-term noise, at which point you would question if that's the right decision to be making, because that's reactionary and not being based on a rational long-term investment decision.
Yep. Particularly when you think about, all investments in equities come with a recommended time frame of a minimum of 5 years. So if you are reviewing the performance of that fund on a 6-month or 1-year basis, that's really not representative of the time frame that you should be looking to commit to that kind of investment. So as Dean says, as we said at the very start, you're more likely to be your own worst enemy by potentially reacting to things and tweaking things in your portfolio than riding out any volatility.
Yeah, definitely. Cool. And so to round it out, quick fire of a few tips around investing. So first one.
Getting us to do quick fire for the last half an hour.
Trying to push you along. So first up is, what is one great investing tip you would give to someone growing their wealth with a long-term time horizon? I'd love to hear answers from you both.
I don't have a tip. I think, there's a lot of great tips. We've talked about all the great tips tonight, right? And you'll hear this. I think the thing for me actually was the living and breathing it and giving people some comfort about what they will expect on the other side of this. It's not a great tip. It's the sensation you get a few years down the track into this journey, and where you start to see it paying off, because in those early days, you don't really see the benefits of compounding. It takes a long period of time for this to really start to work its magic. But a few years after you start on your journey and you've got your plan and you're investing, you'll really start to see a fundamental change in not only the comfort that you have, the lifestyle, or all those other elements that come into play, because at that point, the investments start compounding on themselves, and the return that you see from that compounding actually starts to turn in some relatively large dollars. And that's where it gets exciting, and that's where you start to feel like you're making headway. So it's about perseverance. It's about knowing that actually you are on the right track, and that in a few years' time, you will really start to experience that. It's not a tip. It's just actually giving people comfort that in those early days, it won't feel like you're making a lot of progress, but it does start to really happen, and it happens quite surprisingly quickly, and other things change in your life, right? For me, it was things like, sorry, another ramble, but it was another one was student loan being paid off. So had been saving away, investing, you're starting to see the benefits compounding, and then the student loan gets paid off, other things start changing in your life, and all of a sudden it feels like things really start to get some momentum behind them. For a long period of time, it can feel like you're constantly battling and day-to-day challenges, and then it starts to really get the momentum and you feel like you're on track.
Yeah. I guess my tip would be, because I can see Rachel here has asked about dollar cost averaging, and less about what it is and more about the fact that you just need to do it. And it's about taking that small regular behavior, because oftentimes we overestimate the effect that the investment return can have and underestimate the effect that our own behavior can have on the success of that. And as Dean says, around feeling like when you start out that you haven't made a huge improvement, the thing that will make a big improvement for you is if you can regularly invest a small amount as you can afford, that you can then grow over time, as your income levels change. And, that is the benefit of dollar cost averaging, because you'll be investing into the market every month, every fortnight, whatever your payday cycle is, and making that habit really consistent. And then, of course, 10 years down the track, you won't even know yourself.
Yeah.
I love it. So
what is
the best piece of advice you've been given when it comes to money and investing?
For me, it's more broadly, lifestyle and money generally is, and again, it comes back to personal, and sorry, this is a broad thing, it's a very hard answer, but it was taking on the risks. If you are comfortable taking on risks, taking advantage of the fact that, hey, you've got time on your side. And that could be as simple as wanting to change career or jobs. Make the most of the fact that you've got time on your side and that you can set up some good behaviors, and that if it doesn't pay off, you can correct it and go back to whatever it may be or change decisions. So I think stepping out of your comfort zone and really chasing those things that are important to you or you're interested in or you're passionate about, it's worth exploring. Be it setting up a business, changing job, whatever it may be. For me, that was something I think I had instilled in me, was encouraged to chase something that was important to you. Worst case scenario, there's always backstops. There's always, you can go find another job, and you've got time on your side.
Cool. Yeah. How about you, Kat?
Mine would be just getting started no matter where you are when you're currently faced, I guess, with that like financial money improvement or decision. And I know, someone that submitted a question to us for this said like they're currently 37 and they feel like they've missed the boat. And to that, I just think like you absolutely have not. If you're thinking about your future, you are so far away from 65. Like, there's that meme that goes around where people say like, is it too late to make a decision? And the only day that it's too late is the day after you die. So just, please don't feel that no matter where you currently are, you've missed the boat or you've missed your opportunity, because ultimately you still have a lot of flexibility to make a significant improvement to your finances from here. So just, ignore the fact that there will always be other people that started earlier than you. There's people that started earlier than me. Like, I worked in financial services and I didn't start investing until probably 5 years after I really should have. So, don't beat yourself up about that. Just actually get started no matter what age and stage you're at.
Cool. Perfect. I feel like that is a perfect way to finish up. Do you guys have any last comments or things you want to share before we finish up?
I think I was really excited by the sort of questions that we got, and that people were really thinking about the future. And coming back to the very first starting point, I think there are a lot of people out there now wanting to fundamentally change the relationship that they have and their kids or partners have with money. And so it's great to see that we've got people out there that are starting this conversation, and that's what we want to facilitate and support. So do keep sending in your questions, not just for webinars, but generally reach out. That is what we're here to try and fundamentally change, is help people build long-term wealth and make a change to their life so that they have more choices and can achieve the goals they want to.
Definitely.
Yeah, I love that. And I guess I'd just add that, there's so many things that you can do in your financial realm in terms of areas that you could focus on. So try not to tackle them all at once, because like going to the gym, you're probably going to set yourself up for failure. Start with the things that I guess are really easy for you to tick off first, whether that be sorting your budget, paying off some debt, looking at your KiwiSaver, starting investing for the first time, all of those sorts of things, and tick through that process, piece by piece, rather than getting too overwhelmed, because you absolutely can get started and you'll feel great about it. I promise you that much. We can assure you of that.
Awesome. Love it. Cool. Well, thank you so much for tuning in, everyone. And if you do have any extra questions or we weren't able to answer your questions tonight and they're burning, feel free to reach out to us. We'll do our best to answer them via email or chat or whatever. So cool. Thank you so much.
Number,
Yeah.
So,
chances are you'll probably speak to one of us. So if you have a really key question you want to ask, we will answer it. So yes, please do
you can see lockdown in Auckland. We want to have some social interaction, so feel free to call the team. Thanks, everybody. Thanks, Christine. Thanks everybody for tuning in.
All right.
No worries. See you.